So you're thinking about getting into buy-to-let. It's one of the UK's most popular investment opportunities. But have you asked yourself, is this actually suitable for me? In the next few minutes, I'll help you figure out whether property investment is actually the right fit for you and how much you need to get started. Hi, I'm Tom from Source Investments. Over the last decade, I've helped hundreds of investors, from first-time buyers to seasoned landlords, build successful property portfolios. We manage around 400 properties across 20 different towns and cities in the UK, so I've seen firsthand what works and what doesn't in the buy-to-let market. You're watching this because you're either brand new to investing in property or an existing investor sense checking what you think you already know. Maybe you're excited about the potential returns, or maybe you've heard about other investors making it work. But here's the thing, it isn't going to be right for everyone. In this video, I'll share what I've learned over the years, including the common mistakes to avoid and what successful investors do differently. By the end, you'll know whether you're ready to move forward or if you have some more work to do first. Before jumping in, there's one thing you need to ask yourself. Can you afford to live without the money you're investing? If the answer isn't an immediate yes, then you need to pay close attention to what's coming next. I'll explain why financial stability is the foundation of successful property investing and how it can make or break your investment journey. Let's talk about why the money you invest in a buy-to-let property should always come from disposable income. These are funds that you don't need for your day-to-day life or are not from short-term savings. Investing is never a guarantee, and despite the low-risk nature of long-term property investment, it's no exception. If your investment funds come from money you need to live on, you're putting yourself at unnecessary risk. What happens if the rental income is disrupted for some reason? You need to be able to cover mortgage payments without panicking about your finances. By using disposable income, you won't be forced to sell your property at the wrong time. The property market works in cycles, and if you need quick cash, you might be forced to sell at the worst time. I've seen this happen firsthand. Investors who just weren't financially stable enough when they entered buy-to-let and ended up having to sell out within the first few years. The reality, their capital was more like emergency savings. It wasn't investment-ready funds. And unfortunately, they missed out on the real returns that come further down the road because they didn't have the financial stability to hold on. When your investment comes from disposable income, you can think longer term. You're not pressured to achieve immediate returns, and that's where property investment really shines over time. You can wait out fluctuations, and if you did want to exit your investments, you could do so at the optimum time in the housing cycle. But most importantly, above all of that, you'll have peace of mind. You won't be constantly checking your rental income, stressed about whether it will cover your bills each month. You can focus on making smarter, more strategic decisions, knowing that your basic financial stability is secured. So before you invest, my advice to you is to make sure the money you're putting in isn't essential for your daily life. Here's a question I get all the time. How much money do you really need to get started in buy-to-let? If you're not clear on this, you could be setting yourself up incorrectly. So let's break down the real numbers you need to know before jumping in. The major number for us at Source Investments is £50,000. Now, this isn't the absolute lowest amount needed to enter the market. You can certainly get started with less, but I would strongly recommend you have around £50,000 as a minimum before diving in. Here's why. We're assuming you're getting a 75% loan-to-value mortgage, essentially the amount of debt you're borrowing compared to the property's purchase price. Let's break down how £50,000 gets used in a typical scenario. I use this figure as a minimum because, more importantly, it gets us to a purchase price of around 150k, which I'll come on to in a minute. First, you'll need a deposit of £37,500. That's 25% of the property value, which is a standard for the level of deposit needed for most buy-to-let mortgages. Next, you'll need to factor in stamp duty land tax, which in this case would be £4,500. On top of that, you've got legal and finance costs, which usually come to around £3,000. This covers things like solicitors' fees, disbursements, and any mortgage application and valuation costs. Then there's the cost of setting up the property, which can really vary depending on the condition of the property and whether you plan to present it furnished or unfurnished to tenants. In this example, I'm setting aside around £5,000 for this, but it does vary, and I'll cover whether it's worth furnishing your buy-to-let or not in a later video in this series. Finally, and this is crucial, you should set aside a cash flow buffer. This gives you a safety net for any unexpected costs, such as maintenance or any periods where the property might be vacant. Now, why focus on properties priced at or above £150,000? £100,000. One major reason is capital growth potential, which you start to miss out on the lower you go below this. In another video, I'll cover how to select the right properties, but the key point here is that lower priced properties, while they may offer higher yields in the short term, they do carry more risk. The best investments, in our opinion, they strike the balance between rental income and long-term capital growth. And £150,000 is usually the tipping point in the UK where you can get that balance. Let's talk about portfolio building. If you don't have the means to potentially grow a portfolio of 3 or more properties in the near future, buy-to-let might not be the best fit for you. It's not just about owning one property anymore. Single property landlords typically don't benefit from the economies of scale or diversification that larger landlords have. A recent report by Savills showed that landlords with 3 or more properties consistently outperform smaller landlords in both rental yield and capital appreciation. It's easy to say you're a long-term investor. Of course, I'll be able to hold on to this property for years, but are you really? What kind of personality do you have when it comes to investing? Do you move your stocks and shares around at the first sign of trouble? How much do negative headlines drive your investing decisions? The truth is, the most successful investors, whether it's in property or other assets, they're the ones who can see past all of that. They're the ones who are truly long-term investors. Let's talk about what it really takes to stick it out and why time in the market matters more than timing the market. Let me share a story about an investor named Vic. In 2005, Vic bought a property in the southeast of England for £175,000. At the time, he rented it out for £750 a month, which gave him a 5.5% return on his investment each year. By 2010, after 5 years, the rent had increased and his return had gone up to 6.5% each year. Vic thought about selling at this point, and if he had, he would have sold the property for £196,000, making a profit of £21,000. When you add in the rent over those 5 years, Vic would have returned £64,000. Now that might sound like a great result, but if Vic had kept the property for just 5 more years until 2015, his total return if he had sold then would have jumped to £162,000. By 2020, this would have grown to £324,000. And if he still owed the property today, his total return would be around £465,000, which would have given him an average return since 2005 of over 13%. And I know this story well because Vic has been a client of ours for the last 10 years. Luckily, he didn't sell in 2010 and still owns that property today. It's a great example of how long-term investing can really pay off. One of the biggest factors in any investment is risk management. Fortunately, UK property is one of the lowest risk asset classes, and property prices are 40% less volatile than the stock market. That said, the shorter your holding period, the higher the risk. Based on historic UK house price data, the odds of losing money on a property over a 5-year period is low, but it's still around 20%, especially if you bought at the wrong time, like during a housing bubble or before an economic downturn. However, if you hold your investment for 10 years, the risk of losing money drops significantly to below 5%. Research from Nationwide and the Office for National Statistics shows that in the last 50 years, there have been multiple 5-year periods where prices either stagnated or fell, like in the early 1990s and the aftermath of the 2008 financial crisis. However, in modern UK property market history, house prices have never sustained a decline across a 10-year period. Finally, the property market in the UK moves in cycles, typically lasting around 7 to 10 years. If you sell within 5 years, it's more than likely you have not seen out a full cycle, meaning you could be leaving just before the market enters an upswing. Many investors panic when they don't see the returns they expected after a few years and can lead them to selling too early. Investor behavior in downturns often becomes irrational. According to a study by Barclays, during downturns, many investors make emotional decisions, with up to 45% selling assets due to fear rather than logic. And by sitting on the sidelines, they miss out on the market rebound. By holding on longer, you give yourself the chance to ride out any dips in the market and cash in during the upswing. So if you have 50k, the means to grow to 3 or more properties and have a long-term view, then buy-to-let is likely a really good fit. Here's the next step. Before you jump into your first investment, there's a checklist of crucial things you need to know to get set up properly. This is where we typically see so many new investors make mistakes. If you're serious about getting started the right way, don't miss the next video where I'll walk you through everything you need to have in place before buying your first property.